I wanted to show you the emblem today, the badge, but my background is not as good as it should be. Welcome to this live webinar. We're looking today at the benefits of being non-dom for expats. So it could be quite extensive. And in our topic of discussions over the last 2 months, we've covered that. In these webinars. So welcome everybody to this live webinar. And we start now. What are the non-dom benefits for UK expats? What I'm looking at here in particular is not, that ding dong tells me I've started it on time. What we're looking at here is not the benefits to UK expats living and working abroad. We're looking at what is the benefits for expats living and working in the UK. So that's the specific narrow topic that we're looking at today. We've got this series that we've done since the 4th of July, which was Tax Independence Day. Anyone who lives in a calendar year from the January, 4th of July, they become tax resident or non-resident, as the case may be. What we're looking at here in this series is all the different residency, non-residency and domicile issues. I hope my internet doesn't give out. So that's what we're looking to cover. So consider some of the other webinars and videos that we've got. If you want a bit more information, you can deep dive into our retained client archive to look at information there. So what are the benefits of being an expat living and working in the UK but being non-domiciled to the UK? We talked before that there's a difference between residence, tax residence and domicile. And what is that? You can have a home in a country, you could have a holiday home in Portugal, in Spain, in Cyprus, in France, and you can be resident there for some of the time of the year. But you become tax resident only when you've lived in that country for more than 183 days. That's the point of the 4th of July for a calendar tax year. You can have a home in Romania, in Cyprus, in Australia, but not necessarily be resident there. A tax resident is when you've lived and worked in that country for more than 6 months during the calendar year. Now, different countries have different tax years. However, there's still ways around it. So, if you're in a calendar tax year country, then 4th of July, you technically become tax resident for that period. If you're a nomad, you might say, well, I'm going to stay here for 90 days and move on. I'm going to stay in Indonesia on a 180-day visa, and then I've got to move on. And I'm not tax resident there, which is a fair point. And in the EU, you have the Schengen zone, where members of the Schengen zone, a resident can only stay for 90 days at a time. So 90 days in 6 months is all that you can stay in a country in the Schengen zone, even for EU citizens, unless you become a tax resident in that country. So there are different restrictions for different countries on the visas and the permits and the access that you get. But if you're an expat and you're tax resident, that is a temporary status, and it can vary for a period of time. Under international law, after 5 years, you can become a permanent resident. And that's, again, it's a generic thing that's available in different jurisdictions under slightly different rules. Each country can set its own rules and requirements, but generally after 5 years, you become a permanent resident. And that all ties in with the general international tax laws, which look at a 7-year period. of migration. So the expat status, in terms of focusing on tax residency, is essentially a temporary short-term period, somewhere between 0 and 7 years, as an expat. You can have a home in more than one country, but where is your permanent home? Where is your permanent economic interest, and where are you habitually staying? So you could be living and working in Dubai as your place of work, the place where you live, and the place where your family is. That would be deemed to be your permanent home for tax residence points of view. Okay, so that's the temporary tax resident status. You've got any fixed income in your home country. So if you've got a villa in Spain that you're renting out, that income on that rental income should be paid in Spain. If you've got a property in the UK that you're renting out, that rental income is taxable in the UK. If you've got a property that you own in Cyprus and you sell it, that capital gains tax is payable in Cyprus. However, you could, as an expat, have a dual residency and tax in those different jurisdictions, depending upon what type of income and what the rules are regarding movable, or those examples of movable and immovable or capital gains taxes. For example, a capital investment or cryptocurrency realized in one country then become taxable in that country, potentially, as well as the rules in the country in which you're tax resident. So lots to think about for expats in terms of tax residency on a temporary basis, 0 to 7 years. So let's consider domicile. The domicile is your default tax residency. So if you don't have a formal tax residency as an expat, if you don't qualify as an expat tax resident in Portugal or Spain or Indonesia or Philippines or Australia or Cyprus, then your domicile is your default tax residence. And that may or may not catch up with you. But my suggestion is that in ProAct, we always believe in following the rules to minimize your tax liability going forward. And this is where it becomes complicated, because when you look at the wordings and the language that's used, it becomes quite complicated. So your tax residence or non-residence can be determined, defined by where your permanent home is and your economic interests, but your domicile is also defined as where your permanent home is, but it doesn't mean the same thing. Domicile is where you're from. So let's have a look at what domicile is. What is domicile? Domicile is where you're from. So generally, under international law, it's the nationality of your father. If you're not married, it could be the nationality of your mother, as well as the country in which you're born. So your parents could come from India and you'd be born in the UK, then you could still have a domicile of India. However, domicile can change. It can change for adults, but not necessarily for children. And it can change over time. And sometimes that's a matter of choice for tax reasons. Sometimes it's a matter of it's not a choice matter. It is something that's decided by the rules. So for UK expats that leave the UK, or for an expat that becomes UK domicile from the time they spend here, the big tax that they acquire is 40% inheritance tax. Now, you don't pay that till you die, but you do pay 6 months, within 6 months of dying. See our other webinars on this topic. that 40% tax liability is on all your worldwide assets at the date of your death. So you pay all your income taxes, all your capital gains, and after you've paid that, you've got the other 40% inheritance tax on death. So that's what domicile does for you. Different countries have different perspectives. So Cyprus has no inheritance tax. So if you're domiciled in Cyprus, you've got no inheritance tax to pay, which can be a good thing. Other countries have forced heirship rules, which could be a negative. Some countries have forced heirship and inheritance tax, which is a triple negative. So there's lots of things to consider as an expat once you start moving abroad, and once you start going beyond that temporary period of non-residence over 5 to 7 years. Now, it actually takes a long time to change your domicile, and when we look at the non-dom benefits for expats living in the UK, we can see how these timescales fit into the general pattern for expats around the world. So a UK expat working abroad for 20 or 30 years can get the same outcomes in terms of migrating and choosing a domicile away from the UK as expats moving into the UK can consider. So, if you're following us so far, we've clarified the confusions that can arise in name, in terms and definition. But what we're looking at here is specifically domicile. This is where your parents are from and where you're born. And that is your permanent home. So let's look a bit more now. If you're non-domiciled to the UK, what are the tax benefits of coming to live and work in the UK? As a non-dom, living and working in the UK, you can pay tax on a remittance basis. Now, there's advantages and disadvantages for that. But if you're an expat living and working in the UK and you're not domiciled to the UK, all your your earnings are paid not into the UK. So if you're paying into a bank account in Portugal or France or Dubai, then it's not remitted into a UK domain, a UK bank, the UK system. So you can earn up to 2,000 a year, and it's not reportable and it's not taxable in the UK. So expats that are non-domiciled to the UK with £2,000 of worldwide earnings is not reportable and it's not taxable in the UK, as long as it's not remitted. If an expat that's non-dom lives in the UK, got worldwide earnings more than 2,000, it is reportable. So they have to do a tax return in the UK. Let's say you've earned 50,000 from your worldwide income, whether that's investment income, crypto, capital gains, or other earnings. You have to report it on your tax return. But there's no tax to pay as long as that income is not remitted into the UK. So if you bring the money, your overseas earnings, as a non-dom, into a UK bank account, it's reportable and taxable in the UK. But if you're non-dom to the UK, working remotely in the UK as an expat, but remitting income abroad, that is not taxable income. Okay? Now, it has to be reported. The gains have to be reported, but they're not necessarily taxable. And that situation can continue for a while. Now, non-doms can get hit with a large tax. There's an annual charge that expats, non-dom expats can pay for being taxable on a non-remittance basis, on a remittance basis. So let's consider that next. The annual charge for non-DOMs starts at £30,000. Not all non-DOM expats working in the UK have to pay that. You have to be a tax resident for 7 of the previous 9 years for you to be liable to pay that annual charge of £30,000. That is up to you. But new expats that are just non-resident tax resident in the UK on a short-term basis, earning from abroad on a non-remitted basis, do not have a tax return, although they have a tax return, but are tax liability in the UK. Once you've had more than 7 tax years within a 9-year period in the UK, even if you're as non-domicile, you've then got the remittance annual charge to pay of £30,000, and that follows around with you each year. So obviously, the encouragement then is by 7 years. The incentive is, unless you're a very big earner, an expat, even a non-domicile, would mark themselves as and want to pay tax in the UK on their earnings. Remember, we're talking about earnings that aren't remitted in the UK. So obviously, it's not a job that can be carried out in the UK employment and paying national insurance necessarily either. But an expat, a non-dom expat, not remitting income could pay no tax for up to 7 years. After that, the remittance charge of £30,000 would apply. The next big benchmark I want to highlight is 15 years. If you've been a tax resident in the UK for 15 years or more, and you're currently a tax resident, in that year of self-assessment, the UK will consider you to be domicile. So you lose the right to the remittance basis to save tax. So a long-term expat who's been in the UK as a tax resident for 15 years or more is going to be liable to tax as if they were domiciled in the UK. So their domicile, without them choosing, becomes deemed to be UK by HMRC. And this is common to other countries around the world. So with Cyprus, a non-dom expat pays no tax on dividends or interest for up to 17 out of 20 years. But after that time, they become domicile, and therefore they're then liable to the local rates of tax on that worldwide income. So by 20 years of living in a permanent country of your choice, with your permanent home, your family, and your economic interests. So if you're living and working abroad in Dubai, in Portugal, in Cyprus, in France, for 20 years, you then migrate and either be deemed domicile in that country or have a domicile of choice in that country. So for a UK expat living and working abroad, that saves them inheritance tax, but it can also lose them some of the other benefits. The expat in the UK loses the benefit of only being taxed on a remittance basis after 15 years of being a tax resident in the UK. Rishi Sunak and his wife were, according to reports in the media, paying tax on a remittance basis from their worldwide earnings because they hadn't been tax resident in the UK and were able to consider themselves, especially the wife, Mrs. Sunak, who was born in India of Indian parents, and that's where her business and her economic interest is, was able to claim remittance basis, and it's only the money that was brought into the UK that was taxed, even if she was paying after 7 years the annual charge of £30,000 until she'd been tax resident for 15 years, when she would be deemed to be domiciled and pay tax on her worldwide income, which she's done voluntarily now. So domicile does change. An expat long term living and working abroad, their domicile will change. So over a 15, 20-year period, your domicile will definitely change. If you want to change it sooner for inheritance tax purposes or capital gains tax purposes, then that's about planning. It's about using family trusts and family companies to manage your family and business income in different jurisdictions and different tax residencies to reduce your income and capital gains tax over that period of time. In the longer term, domicile becomes a factor. And again, trust can protect your family and business income and capital for living and working abroad. If you want more help and guidance, contact us at projectpartnership.com. Just see the website there. And we can help and guide you with living and working abroad, across border and down generations, to protect their family, capital and business in property, to make sure that your family are the ones that benefit and not the taxman. We follow the rules and make sure that we do things right so that your family is protected and you can hand that money down with confidence down the generations. Thanks very much for listening. And don't forget, subscribe to our YouTube series down below. Share it with friends. Find a friend, add them as a subscription. We want to get to 1,000 subscribers by the end of this year, please. Your help is appreciated when watching this. We've got the series which we've run since the 4th of July on tax residency and independence and the implication of domicile and tax residence. Let's look at that in a bit more details. If you've got any questions and help and guidance on how to organise your family, your business, your property assets, contact us at projectpartnership.com. We've got a retained client service which just offers online advice and guidance or consultations. We offer free review to all new inquiries to help and guide you. So subscribe below, follow our YouTube, consider enrolling and subscribing as a retained client, and keep in touch and let us know how we can help you maximise the benefits of your non-domicile status as an expat living and working abroad. Thank you.